The Fed has hit the pause button. They will have to remain at current levels, but then at some point they will hit the panic button and start lowering rates again. And I think that this will really be the point in time when gold picks up momentum. If you have a look at the forecast based on Bloomberg, all the analysts that are questioned, it seems that everybody's bearish on gold. So that's a pretty good setup from my point of view. And I think there are no triple tops. I think once we go over, then gold will really pick up momentum, and we can go to 2,300 pretty quickly.
As gold prices hover near session highs, testing a crucial resistance level at $2,050 per ounce, market analysts, including Ronald-Peter Stoeferle, managing partner at Incrementum AG, scrutinize various factors that could impact the precious metals trajectory. Stoeferle contends that while the Federal Reserve is currently on pause, interest rate cuts in the future may be possible, potentially propelling gold prices to reach $2,300. The precious metal has managed to sustain above the psychologically significant $2,000 level, with expectations of a Fed interest rate cut in March 2024, lending support to gold. The stabilizing U.S. labor market, indicated by a steady number of first-time unemployment benefit applications, contributes to the positive sentiment around gold. Stoeferle emphasizes that geopolitical events, such as conflicts in Russia, Ukraine, and Israel, historically led to increased interest in gold as a hedge against inflation, more debt, and lower interest rates. Highlighting the significant gold flows from the west to the east, particularly into China and India, Stoeferle underscores the cultural significance of gold in these markets. Recent data reveals a marginal rise in gold demand in China, the world's largest gold-consuming nation, and a notable 10% increase in demand in India, the second-largest consumer. Stoeferle suggests that these trends could have lasting implications for global gold demand. Moreover, Stoeferle argues that gold may reclaim its position in Western portfolios as a foundational asset rather than merely a satellite investment. The potential for heightened inflation makes gold an attractive hedge, especially given the end of the Great Moderation. A recent example reinforcing this perspective is the uptick in gold prices in September, following higher-than-expected U.S. consumer prices, raising concerns that the Federal Reserve might maintain higher interest rates for an extended period. Before diving into Ronald-Peter Stoeferle's insightful interview, subscribe to our channel and give this video a big thumbs up.
See at the moment is, CTAs, managed futures, and those kind of momentum-driven participants. I think they're still kind of on the sidelines, and I think signs like this, a monthly close above 2,000, would probably trigger some buy orders for like more technical oriented investors and programs. That could be one thing, and then I think it's what's really important from the current or the short-term price action. We crunch the numbers regarding gold reacting to geopolitical events. When the whole tragedy in Israel started, people got really excited about gold, and we always said, well, actually those rallies are rather short-lived, But then on the other hand, what does war mean? It usually means more inflation, more debt, and lower interest rates, So I think those developments, those very unfortunate geopolitical events that we're seeing, and it's not only Russia, Ukraine, and Israel, it's also some other minor geopolitical conflicts that seems to be popping up, make a stronger case for gold. But I think what's really important, Paul, is that I really want to make a positive case for gold, not wars all over, hyperinflation, buy gold. I think if you have a look at the gold flows from the west to the east, this is really staggering. And we had a whole chapter about the gold flows and the infrastructure of Asian markets and how it developed. So actually over the last 20 years, 30,000 tons of gold moved to China and to India. China and India used to be 28% of gold consumer demand. Now they are responsible for 50%. Indian housewives own more gold than the US owns with their 8,100 tons. In general, the Indians own more than the combined amount of the 27 largest central bank gold holders. And I think for us in the Western world, those numbers, they're somewhat underreported, yeah. And I think it's really important how much gold is really flowing into emerging markets, and it's actually not coming back, yeah. And I'm going to Dubai next week. I'm traveling quite a lot at the moment, and if you go to other cultures like Dubai, for example, their affinity for gold and the importance for gold for people there is just a completely different one. It's like the foundation of a portfolio. It's not like somewhere in the investment universe. It's a satellite investment, an alternative investment that you add to your balanced portfolio. It is actually the foundation of the portfolio. And I think with inflation proving to be pretty volatile, and I said in my keynote, we've seen the end of the great moderation, so basically 4 decades of falling inflation. I think inflation volatility will become a main trigger going forward. I think that gold will slowly but surely also in the Western world come back as a, just a, the foundation of the portfolios, because the higher inflation is, obviously the more gold you want to have in your portfolio. And I think this could be changing, but it's a long process.
In October, central banks globally added a net 42 tons to their official gold reserves, underscoring the enduring significance of gold as a stabilizing force in uncertain times. The People's Bank of China emerged as the foremost buyer, followed by the Central Bank of Turkey and the National Bank of Poland. Stoeferle attributes the resilience of the gold market to central bank gold purchases, especially during periods of geopolitical tension. Countries increasingly recognize the vulnerability of their currency reserves, prompting strategic moves to bolster their gold holdings. In October, some central banks focused on getting more gold. The Reserve Bank of India got 3 tons. Also, the Czech National Bank got 2 tons, the National Bank of the Kyrgyz Republic got 1 ton, and the Qatar Central Bank got 1 ton. These actions made them stand out as significant buyers during that month. Stoeferle underscores the long-term impact of central bank demand on the gold market, serving as a sturdy foundation for future growth. He anticipates that the impending breach of new all-time highs in dollar terms could trigger heightened interest from Western financial institutions, potentially through increased participation in gold ETFs. Let's get back to the interview.
I'm not sure if it's de-dollarization. I would say that before we see any de-dollarization, we will see a de-euroization. Yeah, and I tweeted out the chart regarding the market share of the euro and the dollar in the SWIFT system. And actually, for the dollar, it's still going up, and for the euro, it's collapsing. Yeah, so I think that the euro will be the next victim of this development. And I think that last year we saw an all-time high in central bank gold buying, 1,100 tons, up 180%. The first 3 quarters of this year, 800 tons of buying. And I think that actually we tend to criticize central banks quite often, interest rate policy, but then when it comes to their physical gold buying, I think it actually saved the gold market in the last year, because I tweeted out a couple of charts showing, this enormous divergence between the tips and the gold price. And I think it really started with the Ukraine war. So actually this was the time when many countries that are somewhat critical to the United States realized that actually with the stroke of a pen, currency reserves can be wiped out. And I think this was a big warning shot to many other countries, like China, obviously. They've been buying like crazy recently, but also Turkey. But then there's Poland, for example, wants to double its gold reserves up to 600 tons. Singapore was buying. So it's the usual suspects, but then also some other countries. And I think, those central bank buying programs, they will remain for the next couple of years probably. Those are long-term programs. And I think this is a really essential physical driver for the gold market. Because, and this is something that could also be some sort of a trigger for the next stage of this rally. Actually, Western financial investors have not participated in the rally so far. So we've seen six consecutive quarters of outflows in gold ETFs. And also there is a big divergence between the West and the East. North American and European ETFs were sold, 200 tons, while Asian ETFs were buying. So I think this is quite telling. Central bank demand being really robust. There is no Western financial demand, but I think as soon as we hit new all-time highs in dollar terms, I think that this FOMO will kick in and that ETFs will become one of the triggers going forward.
In your latest monthly gold compass, published in November a few days ago, you said you highlighted how gold is proving resilient, noting once again it surged up to that $2,000 per ounce mark in October. Why is it proving so hard to get over that $2,000 per ounce?
It's a psychological thing. So probably many people think, 2000, we could never really take out the all-time high. That's a big psychological number where some, just want to sell. On the other hand, I think, we're always staring at the dollar price of gold, while in so many, basically in every other currency, gold has made new all-time highs over the last couple of months. In Japanese yen terms, gold is up 25% year to date. In euro terms, gold is up, I think, 8.9%. So actually, I think gold is exactly what it's supposed to do. It's protecting you against loss of purchasing power. It's pretty stable. Volatility is fairly low recently, and I think that's the interesting thing.
How might potential interest rate cuts and geopolitical events impact the trajectory of gold prices, especially considering the stabilizing U.S. labor market and the historical significance of gold in Eastern markets? With central banks globally adding to their gold reserves, how do you think this reflects the enduring importance of gold as a stabilizing force? And what implications might it have for the future of the gold market? Share your thoughts in the comment section. If you liked the video, please subscribe to our channel and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.